once that phase starts to go, it can be a really quick lightning rod for gold and silver. And we're starting to see that this year. So fast forward to today, and everyone's like, "Oh my gosh, how high is Jerome Powell going to hike interest rates?" Well, we found out that they're going between 4 and 5%, which isn't that high with inflation running, 7% this year, 7% last year. So even between the past 2 years, the Fed fund rate of 5%, say, we'll give them the benefit of the doubt, and inflation at 7%. You're at -2% holding, even if you invest in those bonds, you're yielding, -2%. So it doesn't really give you much confidence in holding dollars, basically.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and excited today as we're going to dig into some of the dynamics between the gold price and the interest rate changes, whether they be hikes or reductions in interest rate policy, which I know there's the tendency to think interest rates go up, gold and silver are going to get clobbered, interest rates go down, it will be the reverse, although historically, it has not always played out like that. So I am fortunate to have Greg Crennan on the show from Golden Coast Consultants, who has been researching and digging into a lot of these things, as well as a lot of the other things that happen with the Fed and out there in the economy. And is also a student of Austrian economics. So Greg, it's great to have you on the show. I've been enjoying following you on Twitter and seeing some of the things that you share, and especially in this particular time. It's a pleasure to have you here, and welcome on in. How are you doing today, my friend?
Thanks, Chris, and Merry Christmas and Happy Holidays to you and your listeners.
Well, I appreciate that, and certainly nice to have you on here, especially at this time where we have seen a rally towards the end of the year in both gold and silver, which is interesting because here we take a look at the 1 year silver chart, which has had quite a volatile year. While the Fed was hiking rates for a while, we saw silver get absolutely clobbered before rallying over the past 2 months. Similar profile for the gold price as well, which leaves us in a situation where we've actually seen the metals move in both directions in the midst of interest rate hikes. Although, why don't we start there, and your thoughts on, is it necessarily a case that when the Fed is raising rates that normally is a bad thing for the metals, or what would you say there to help start putting that into context for people?
Yeah, absolutely. So we all know that if you want to own physical gold and silver, that it doesn't produce any yielding returns for the physical. So when you have interest rates rising, there's always that argument that why would you want to hold as an investment gold and silver when you can get some sort of ROI? But the issue is that uh, this year specifically is that when the Fed started hiking their interest rates this year, they never gave a short-term limit. So they didn't say we're going to raise interest rates and stop at 4%. And so when they were raising the interest rates, we're going to keep raising the interest rates. Well, then we're going to fight inflation. We're going to keep raising the interest rates. And when the people are seeing these inflation data reports come out, and they're seeing 9, or we never had a 10 handle, but I think a lot of people would say that inflation is higher than 10% today. So when the Federal Reserve, the speakers, Jerome Powell come out and they say we're going to keep fighting inflation and we're going to get this nipped in the bud. Well, people are thinking, wow, interest rates are probably going to have to go to like 10% to get this inflation down. Well, then, just recently, Powell says, yeah, we think the terminal rate is going to be like 5%, and we're already at 4% today. Well, inflation's still higher than 4 and 5%. So that means that the rate of return on real yields versus inflation is negative and not positive. And so when you look at history, the whole point of from 1971 to today, because before 1971 the currency was gold. So from 1971 until today, when you're on just a complete fiat standard, one of the ways to tame inflation is to have the higher real positive interest rates. But why are they raising the interest rates? They're raising the interest rates is because the currency is losing value because it's not backed by anything. So usually from the longer periods from like 71 to the 80s, when you had Paul Volcker raising the interest rates, that's because the currency was losing its value. And to stabilize the currency, the interest rates had to be positive. So people were exiting the currency because it was being devalued, and they wanted something to hold their value while interest rates were rising. But the interest rates really didn't get positive until like the very end. And then eventually, when the interest rates peaked at 20%, you had gold peak as well because the currency was finally stabilized. So you had markets at the time, bottom. So you have, oh, look how much gold, if you bought gold in 71 when it was valued at 35 and now it's valued at almost, $800 an ounce at that time period, and everything else collapsed in value in dollars. Your gold could buy you a lot more things, especially when everything stabilized. But the thing is that, and then the gold price came down. You fast forward to like the 90s, you had interest rates kind of around the 5% range during the 90s, and they kept the interest rates there in the 90s for like about for about most of the decade up until the very end. They raised them. I think if you have a slide about that. Yeah. So yeah, they had them lower. We had the early 90s recession. The Fed lowered the interest rates, and then they raised them a little bit coming out of the recession right there. And they kept them right, which is about 5% for most of the decade of the 90s. That fueled the tech bubble. And then obviously Greenspan raised the interest rates in 2000, 2001 to 6%. Then that eventually popped everything. So you had all these non-cash flow companies, non-profitable companies, all these .com companies, and they just started, dropping by the wayside. Well, gold bottomed in 2001, and then it was basically like off to the races because another factor besides interest rates for gold and silver is that it's about decay or still existing around. So like you can invest in a company can go bust, and you have now $0. So as investors, when you had all those companies falling wayside in 2001, 2002, investors were seeking something to store their dollars basically, and they didn't want to store them because the interest rates were low. So the money flew into gold and silver, which drove the prices up. And that was the same kind of thing, similar scenario in the 70s and 80s as well. And so you basically have this cycle of like when there's because the dollar and most or all the currencies are all based on interest rates. It's really just faith. So once that faith starts to go, it can be a really quick lightning rod for gold and silver. And we're starting to see that this year. So fast forward to today, and everyone's like, "Oh my gosh, how high is Jerome Powell going to hike interest rates?" Well, we found out that they're going between 4 and 5%, which isn't that high, with inflation running, 7% this year, 7% last year. So even between the past 2 years, the Fed fund rate of 5%, say, we'll give them the benefit of the doubt, and inflation at 7%. You're at -2% holding, even if you invest in those bonds, you're yielding, -2%. So it doesn't really give you much confidence in holding dollars, basically.
Yeah, and I'm glad you mentioned that because it's something that I don't think gets quite enough attention because people are talking about, all right, the rates are going up, and with a higher rate, then you're getting a return, whereas on gold or silver, it's a piece of metal that's sitting there. Yet we're still in negative real return territory. And do you think it's just that we've gotten to the point where people now see the light at the end of the tunnel with the Fed hikes that has changed what we saw earlier this year? Because we did see that decline. Gold was over $2,000 down to below 1,700. Silver going from 26 down to 18. Is it just, do you think that we've reached the end of that? Because we've been in that negative real return environment that entire time. And perhaps it's just that in the beginning of the rate hiking cycle, people didn't know what to expect, or what would you say about that there?
Well, there was a lot of issues, right? So, last year we had the everything bubble, and a lot of people always get confused that when bubbles are persistent in the least recent history of the U.S. stock market, gold does not participate usually in bubbles. So like the price of gold was flat during the 90s when the Nasdaq soared for the tech bubble, and it wasn't until once everything blew up and fell wayside that the price of gold then rose again. Same thing with the housing bubble, gold, it did rise during that time period, but it wasn't really until the Fed stopped raising the interest rates in 07, 08, and then everything fell wayside after 08, and then gold continued, its march higher. Now silver is a little bit different of a commodity than gold. But today there's, more of an issue or more of a reason to be bullish on silver, just because it's not just anymore a industrial. It is an industrial metal, but not industrial that we used to think of it as an industrial metal. Now that most of the governments and are pushing for this clean, new era of energy, silver is the best metal for solar and needed for a lot of these projects. And so now we just artificially, right? So, but with the government getting in the way of free markets, by pushing policies, telling cars they need to switch over, maybe like in California, for example, they say all new housing has to be built with solar. So now you're creating an artificial demand for silver because the government's telling us that we need these clean products, which require silver. Which, if we didn't have it forced on us, maybe the demand for silver may not be so exponential so quickly. So, there's only so much silver that can be mined to meet all these projects for a globe, by the way. And this is global. It's not just like, well, the US is the only country that's pushing for solar and, EVs and infrastructure and charging networks that all require silver. This is a global phenomenon. So it's definitely something that is beneficial for silver that wasn't really a thing more so in like 2008, 2000, and even in the 70s so much as far as the future growth in products that silver is going to be required going forward, basically. So I just think that's a nice new element that doesn't really get taken into the price too much today. And I think people don't realize also that silver, a lot of the things that silver is used in also just gets thrown away and it never gets like the reuse value of it. So that's another great opportunity for people who are invested in silver.
Yeah, and interesting that some of that silver actually is recoverable, just not economically at today's prices. And I know what you mean about the growing demand for things going green. And I continue to wonder if some of these projections are governments saying what they would like versus things that are realistic to ever happen. Because, like you mentioned, in efforts to ever meet some of those mandates, would require a whole bunch of mining. So kind of will be interesting to see how that plays out. Greg, I'm going to pull something up here. This was a great
Sure.
article from Adam Hamilton, who writes his Seeking Alpha column called Gold Thrives in Rate Hike Cycles, which is where we got these charts from. And he mentions this was going back to 1971, and he looked at some of the major hiking cycles. And in 8 of those Fed rate hike cycles where gold rallied, the Fed hiked for an average of 12 times for 449 basis points over 17 months. And that was when the gold price rose substantially. And there were 4 others where there were hikes, 7 hikes on that for an average of 500 basis points. And so he came away with the majority of these hiking cycles. You saw the gold price rise. The 4 where the gold price declined by a lesser rate were when they did more intense, shorter time period hikes. And we can go back to these charts and take a look. It's interesting. One period of time that obviously a lot of gold and silver advocates take a look at is leading up to those price spikes in 1980. Again, gold hits $850 an ounce. And as we see, though, Fed hiking all the way up there. And I guess the common narrative is that Paul Volcker came in, raised interest rates, that broke the back of inflation, and that's what sent gold and silver prices down. Do you agree with that? Or what would you say about that time period we saw in the late 70s where, again, here earlier in the 70s, you see the rates going up, gold going up, then interestingly, the rates come down almost.
Well, definitely. Yeah, if you actually, it's actually crazy from the price. A lot of people, you don't realize, like, when you look at that chart from in gold in dollars, you know it doubled like three times basically, so from like 50, let's just say 50 to 100, 100 to 200, 200 to 400, 400 to 800, right? So those were a lot of, price doublings. And, then you basically, it was very speculative at the peak. And then, it came down, but it came down to, to about $400 an ounce, averaging out basically. But it started out, below $100 in the 70s. And so when I look at that, I do see, because everything eventually gets a fear of missing out, especially when people see the price of anything going up. Uh, and I think that just came back to a more natural, the more, true value of what gold was. And, you can see that even as the interest rate stayed at, 5% during the 90s, it was a store of value. And I think that's what a lot of people need to realize. And that's how I realize it, is that gold is a store of value. So, during that 80s, 70, 80s period, it kept, like, if you bought gold for $100, you know, it kept you what you can buy, for $100 in the early 70s, and then $100 would have been worth, because we forgot that the dollar lost 50% of its value during from 71 to 81. So, if you needed twice as much money for the same amount of goods at, when that decade was over. And so when you see the price of gold rise, you can see that, you kept that purchasing power that you need in the future. And then you can say the same thing for what's going on now. When the Fed turned the money printers on back in 2019, when not QE happened, um, and they lowered the interest rates when COVID happened, and then gold is up about 40% since that, 40, I think, over the past 5 years or so. So 40% some really nice gains, preserving your purchasing power, especially when you look at what inflation's running at. About, reported inflation is running since 2020 at like 25%. So our cost of living is, it didn't quite double yet according to the reports. Some people, you may say that their cost of living has doubled, and you have gold, preserving that purchasing power during this time period.
Although, while that makes sense, one thing that I think it's been a little counterintuitive is that when we look at the Fed's balance sheet, so aside from just the interest rate hikes or cuts, are you surprised with what we saw? And here we can look from 2011 when prices were peaking and where we are now. In the midst of that, again, we did see the rise in 2020, even prior to that. Yet we saw an increase of the balance sheet. And we heard a lot of talk about the Fed was going to, undo the stimulus. They were going to raise rates. They talked about it a lot. Didn't so much happen yet. Certainly a tough couple of years watching those prices come down from the 2011, 2012 levels. What do you think was leading to that over that time period where, again, we see, if you look at the Fed's balance sheet, was increasing somewhat significantly? I mean, here in 2011, about.
Well, I think, yeah, I think just during that time period, because we were in this period where you would go to the grocery store and wouldn't be shocked to see that the price of eggs are now, almost, $1 an egg, $12 for a dozen eggs, which some people are seeing now that eggs are like $12. And, back then, the price of eggs stayed consistent with, $4 for a carton of eggs, right? So I think that has a little bit to do with it. Gold is not just like, oh, like, a lot of people are like, oh, the inflation number, everyone always sees like, oh, I thought gold was an inflation hedge, and inflation was up and the price of gold was down. Like, everyone has a very short timeline, and they don't realize, like, that's not how markets actually work, because people are anticipating things. They are preparing for future X, Y, and Z. And there's gold is another animal. I actually have a chart. I'll see if I can send it to you. That actually gold is better as a fear hedge than, necessarily as an inflation hedge. And what I mean by that is that when there's fear and turmoil, so I have a chart with the VIX and the price of gold, that when there's fear, people flock to the safe haven, which is gold, meaning like you know what you get, you know what you have a value. Everyone else knows what the value of gold is. So when there's fear in the markets, the price of gold rises. When there's no fear in the markets, the price of gold declines. And then that's where you want that risk appetite. Meaning like, so when the price of gold declined, when you were showing that graph, there was no fear in the markets. It was the great, moderation. They were talking about how inflation was too low. You had, during that time period, from '08 basically, and then you had the economy, come out of the recession a little bit. You had some great products by Steve Jobs, from the iPhone, iPad, new Macs, iTunes Store. So you had, Apple obviously from 2008 to when Steve Jobs was there, passed away, and I forgot what year that was. But Apple had a huge run. They were coming out with like product after product. So when you're looking as an investor, it's like, what would you want to invest in? A lot of times, it's not just like, oh, there's inflation, let's go into gold, or there's deflation, let's go into gold. It's really more of a fear. And this year the price of gold was back over 2000, that was when Russia invaded Ukraine. So as far as investors seeking a safe haven, like, oh, snap, we don't know what's going to happen, I want to exit. So you had the markets going down when Russia was invading Ukraine, and then you had the price of gold going higher, and that was because of more of a fear trade. Same thing happened in 2008. Same thing that happened in 2001. So you have those nice correlations, and that's why I think of gold. And when I say we're preserving purchasing power, when people are more fearful, not greedy, because when people are greedy, they want to be in the most like speculative thing ever, cryptos, all the you know, Zoom stocks and all the COVID bubble stocks, all those things went vertical because it was a mania, and you know precious metals don't do well in speculative manias because it's a real asset, and that's what I always tell people is like when they were like, oh, look at the crypto and look at the gains, I was like, that's cool because people are just speculating. Gold and silver are real assets used in the real world, and the price doesn't necessarily fluctuate on massive greed and speculation and of a mania, basically. And that's why the price of gold never does well. If you look at, almost every time there's a mania from 71 on, gold doesn't really do well during big stock market rallies, basically.
Yeah, and certainly that was the environment with the Fed having everything under control and 0% interest rates were great. And unfortunately, we're finding out some of the consequences of some of those things now, which leads to something else that I know a lot of people saw. You shared on your Twitter feed, but we got that news last week. Spike in Fed discount window usage hints at looming bank crisis. Obviously, we had that spike back in 2019. Here's back in 2008. And recently, that rate has been going back up a little bit. And was wondering if you could explain that for folks, what you think is going on there.
Yeah, so the discount window or the repo facility is the overnight lending between banks, hedge funds. And so when things are normal, they're flatlined because, let's say I'm a bank and Chris is a bank, and I go to Chris, hey, I need to borrow an extra $1 billion today to clean up my balance sheet, basically. And then I give you, say, treasuries, you give me $1 billion, and then it's for an overnight agreement, and then I give you back the next day. And so what happens is all these banks across the globe all do overnight lending, and what happens is when I give you or suggest I give you, say, um, a collateral like a treasury, and you don't think that treasury or collateral is worth the money I'm asking for, you decide to stop lending to me. And then you're going to demand a higher or more collateral for me to be able to borrow from you. And then so basically the lending in the financial markets come to a freeze. And so this is, the Fed discount window dates back all the way since they were almost created. And so this isn't something like as a new phenomenon. They did change the name from discount window to the repo facilities. Um, and so you have this overnight lending process that during normal times, because you trust the collateral. And when you don't trust the collateral, you demand more in return. And then the credit markets freeze. And then this is quote unquote where the Fed comes in as a lender of last resort, where then if Chris won't let me borrow, then I go to the Fed and the Fed says, okay, I will take your collateral and I will give you the money. And so when you have here on that chart, you have the two before just recently, you had two prior times. Well, those two prior times was in 2019 leading into 2020. And the other one, the first big spike was during the mortgage-backed security crisis, when basically all the banks were using the same paper for the mortgage-backed security, and we all knew that they were worthless, and so banks didn't want to basically get caught uh, holding the biggest bag, as they like to say, because basically, if I were to lend to Chris the mortgage-backed security, and Chris now has that collateral, but he knows it's worthless, and he gives me the money, I'm the one who's, if I go out, Chris is going to be out the money. So Chris wouldn't want to lend to me. So this is where the Fed steps in and starts printing money, creating more dollars to keep the markets functioning. And I remember I was actually at the NABE conference in 2019 in Denver, when I was one of the first people to talk about the Fed and the repo market. It's been pretty popular, not as popular as many people have seen, but the video of Jerome Powell stating that this is not QE. When I asked him what they were doing in the repo markets were QE, and he kept on saying, let me get this thing straight. This is not QE. And then since then, they haven't been able to. The balance sheet is up over 100% since 2019. Now they're creating more money through the lending market again. And we all know that it can start out small. It started out small in 2007, and then eventually it's going to bloom, because where there's smoke, there's fire. And that means that if one person is holding some bad collateral, it means they're all holding bad collateral. And that, you can see when what happens is you have this massive asymmetry spike, and then the Fed says, okay, I will buy all the dog crap from you all, clean up all your balance sheets, and then now you have all this liquidity. So you have these massive spikes. The Fed comes in, prints all the money, gives it back to the bank, says, we'll take your collateral. And then now you have all this extra money to do whatever, speculate and keep the overnight funding going. And that has happened twice. And now we're seeing it again. So I don't think this is just like a one-off. They're trying to say, oh, well, it's end of the year, tax season, the Fed's stepping in. They said similar stuff back in 2019 also, and then we know what happens in 2020. So, like I said, where there's smoke, there's fire. The only thing is, this would be good if the Fed didn't do anything, because that means the banks would have to go down. It would actually probably reduce inflation, because when you have these overnight hedge funds, banks, and they know that they can always go to the Fed, they just keep doing what they always do, which is speculate, seeing if they can get someone else to, buy into, the garbage basically. And they had the Fed bail them out. Well, if the Fed wasn't there, they wouldn't be misallocating their resources. They wouldn't be doing this. So it's kind of like, until either, I only see kind of like as my forecast and view goes, I only see this ending in two ways. And the two ways that I see it ending is either very bad inflation, or we have a more of a depression, stagflation, where the value of the dollar goes down, and also your assets go down as well, while the government tries to fix what's going on in the markets, instead of letting things happen naturally.
Yeah, it unfortunately does not seem like the ideal set of choices, yet perhaps we talked a bit today about going back to 1971 when gold tie was severed to the dollar, and it's kind of been a snowballing of many of these things ever since then, and has left us in position where, and I don't know if the entire world is seeing it this way quite yet, but like you mentioned, those two outcomes where now seeing pressure in the banking system again. Obviously, a lot of the markets down this year in response to the rate hikes, and everyone wondering how much further will the Fed go. And it was interesting, even in Jerome Powell's press conference last week. I mean, he was talking about rate cuts in 2024. So it's not like they're talking about some long-term hiking policy, and thought that was fascinating for him to throw that in there. So, Greg, last thing I wanted to run by you before we wrap up. I know you're also a fan of the mining stocks, and certainly in a rising gold and silver environment, you have the opportunity to get leverage. Obviously, there are different set of risks involved there than just owning physical metal, but anything that you'd like to share there, or how you approach that could be helpful to people watching at home today?
Yeah, so for anyone who's interested in the mining space, always look for companies that pay nice dividends, companies that buy buy their stock back. And as I analyze as an investor, all the mining companies, I look at the companies today. Many of them have little to no debt. They are paying good dividends, higher than what the Fed funds rate is, and some of them are buying back their stock. These were all like key catalysts for when Apple blew up back in the day. And the thing is, the miners go off of something called the all sustaining in cost, which is basically how much does it take to mine 1 ounce of gold or silver. And a lot of the mining companies today are the ASIC is what they call it. For gold is in like the low 1000s, about let's just say like 1100 an ounce. So for a gold mining company, it takes $1,100 for them to make 1 ounce of gold, and anything above that is profit. And then same thing with silver. A lot of the silver miners, it's about, I would say, low 20s, like 20, 21 dollar an ounce for their ASIC. Now, as the price rises, that's the other thing people don't realize is that people are like, oh, why do I want to be in gold and silver? It's not ever going to bring me, Lambos, like, which was the whole pitch for the crypto space, right? But the thing is with the mining sector is that they are so profitable, even at today's prices of gold and silver, that you don't need the price of gold and silver to be like, oh, I want, because everyone's always like, oh, what do I care about owning gold and silver if it goes up like 20%, because people now, yeah, and that's part of the inflation thing, is people are so used to high returns. Like when I tell someone, oh yeah, this is a nice like 6% return this year, they're like, 6%? What am I going to do with like 6%? Because now it's like entrenched in people's minds with inflation that they're used to like 20, 30, 40, even 50% returns a year, which is not normal, and that's kind of like the thing is like that's not normal. Um, so, but the thing is, the mining sector is so undervalued that if the price of gold and silver just go up 20 or 30% over the next year or two, which, if there's any more geopolitical factors that can get the price of gold higher, silver higher, that, I think that once gold goes over 2000, which it'll be over 2000 eventually, I don't know when, but, I think today we're above 1800. So, I mean, it could be this, it could be this year, it could be next year, but it's getting really close to that cap. And then the other thing is the gold and silver is almost tied to the dollar index or the Dixie. So if the Dixie falls, almost invertedly correlated that gold and silver will rise because a weaker dollar is a stronger or bull case for gold and silver. So going back to the mining sector, with all this talked about, if gold and silver rise, say 20% over the next year, the mining companies, because they're so profitable even at today's price, that their value can increase by like 100x. And the reason is because they have no debt, they are producing an asset, they are free cash flow, paying dividends, and they have low like PE ratios. Like I think Barrick Gold has like a 16 PE today. So you're paying, a lot lower of a premium for future earnings than say something like a Tesla that has a PE of like 50, meaning you're paying, $50 per future earnings. And so, when you look at those things, like, and by the way, Barrick Gold is paying like a 4% dividend yield. So while you're waiting, the way I look at it is, while you're waiting for the price of gold and silver to rise, I can collect 4% from Barrick Gold. And then once the price of gold does rise, I'm going to be a beneficiary of that investment basically. So that's the way that I see the mining sector. So, my best, way that I handle it is always looking for companies that pay on the highest dividends in the sector. Now, right now, because silver just broke out of the low 20s range, uh, not a lot of silver miners pay a dividend. Pass is one of them that pays a dividend, and but it's kind of small. I think it's around like 3%. So, and that's because they're not as cash flow rich as the gold mining sector because gold is just a larger market than the silver mining sector. So that's why I think that the future returns for silver miners, like Fortuna, has a great potential of if the price of silver can get back into the high 20s or even above 30, that these companies will be so flush with cash that they can start issuing dividends or even higher dividends, somewhere more competitive with the gold sector. So, I look at gold as, people are like, well, gold doesn't yield you anything. That's right. But the gold mining sector, they do yield me something. So I can get a nice ROI owning the mining sectors or the mining companies, and I can wait for the price of gold and collect my 4, 5, 6%. I mean, there are some mining companies that pay up to like 7, I think even 8%. So I'll collect that yield all day, every day, waiting for the price to rise.
Well, that makes a lot of sense, and is nice to see that some of the mining companies paying the dividends. I know Fortuna, they've mentioned that that's a matter of when rather than if, so something they're moving towards. And obviously, if you do have a continuation of the gold and silver rally, which when you were mentioning before how a lot of it is based on fear, there's a lot of things that I think people are concerned about out there. So certainly could be a good time for gold and silver stocks. Although, of course, people at home, please invest responsibly. And with that said, Greg, I sure appreciate everything you shared here today, putting things in perspective with the interest rates, also the discount window. And as we wrap up, is there anywhere that people can find you if they'd like to follow some of your research or get in contact?
Yeah, so Golden Coast Consultants on all social media platforms, which makes that easy for everybody. Twitter, LinkedIn, uh, Instagram. So
Cool. Well, I appreciate everything that you're doing out there. Certainly good that we have some Austrian economists. I mean, we have a handful of them, but I think everyone is needed in today's financial environment. So, Greg Crennan of Golden Coast Consulting, thank you so much for joining me on the show today, and hope you and your family have a great holiday. And we'll have to do this again soon.
all right, Chris, I'll see you in the new year.
Well, thank you again to Greg for everything that he shared there. Hopefully that was helpful, especially in the midst of what we're seeing now with interest rates continuing to rise and quite a divergence in some of the metals prices over the last couple months as opposed to what we saw earlier this year. But hopefully that helped shed a little light on how some of these things go sometimes, and that it's not always quite as straightforward as interest rates up means bad for gold and silver. Hopefully that will continue into 2023 as we round out 2022. And before we wrap up, would like to thank BlackRock Silver for bringing us today's video. BlackRock had some drill results at their Silver Cloud project about a week and a half ago, which brought back some high-grade results. Did catch up with Andrew Pollard. And to hear a little bit more about how things have been going there, well, here's a short snippet of our call with Andrew.
We cashed in a lotto ticket that I think not many shareholders knew that we were actually holding, in the sense that we, drilled our grassroots project Silver Cloud, which is up in northern Nevada, not our flagship. And we were giving it one last kick at the can up there. It's a project that is next to two of the highest grade gold mines in Nevada. We've always known that if we were going to hit something up there, it would be, something, similar to Midas, in the sense that Midas produced about 3 million ounces at 30 grams per ton, but those veins were only going to be about 1.5 meters thick. And if we were going to hit something similar, the definition of success up there would be 1.5 meters of maybe an ounce per ton gold. And we hit effectively 2 ounces per ton on a gold equivalent basis over 1.5 meters, tied together an old intercept that Bill Howell, their chairman, drilled 20 years ago when he was with Placer Dome. And finally, we figure out where this thing's running. So we've got 425 meters of strike, something that's similarly hosted, volcanic hosted, right in a graben structure, very similar to how Midas was, oriented the same way as Midas is. And these grades are double the average grade of what they had up there, which grew to become an iconic discovery. And we're just getting started.
Well, thank you, Andrew, and congratulations on the results. To hear the rest of that call with Andrew, where he also talks about their latest progress at Tonopah West, well, that video is coming your way now.